Welcome to this presentation by Facilitators Research. This research is distributed exclusively for informational and educational purposes and does not constitute financial, legal, tax, or investment advice. For such services, you may reach out to speak to one of our officers.
Diversified banks are the largest and most influential institutions in the African financial system. These are universal banks with total assets exceeding $20 billion United States dollars, operating across multiple countries and offering the full spectrum of retail, corporate, investment, wealth, and insurance distribution services. Their scale, geographic reach, and product breadth give them decisive advantages in funding cost, technology investment, and regulatory influence. This presentation examines the diversified banking segment in detail, focusing on the multi-billion-dollar institutions that define it and the strategic choices that will determine their next decade. 8 diversified banks anchor this segment. Standard Bank Group is the continental leader with $172 billion United States dollars in assets and operations in 20 African countries. FirstRand follows at $108 billion with a tighter 6-country footprint focused on Southern and East Africa. ABSA Group, formerly part of Barclays, operates in 12 markets with $74 billion in assets. Attijara Wafa of Morocco has built a 14-country francophone network with $62 billion. Nedbank, the National Bank of Egypt, Bank of Africa of Morocco, and Access Bank of Nigeria round out the group. Together, these 8 institutions hold more than $500 billion in assets. Diversified banks share 5 defining characteristics. They operate in 5 or more African countries, with cross-border revenue typically contributing 15 to 35% of group earnings. They run a universal product set spanning retail, corporate, investment, wealth, asset management, and insurance distribution under one holding company. They have wholesale funding access, able to issue senior unsecured debt in international capital markets, providing a funding cost advantage. They invest at technology scale, with annual technology spend typically exceeding $300 million United States dollars. And they practice cross-sell discipline, maximizing customer lifetime value through product attach rates of 3 to 7 products per customer in mature markets. In the 2023 financial year, the leading diversified banks delivered an average return on equity of 14.2%, with FirstRand leading the pack at approximately 22%. Net interest margins averaged 4.8% across the group, with South African banks at the lower end due to competitive pressure and Nigerian and Egyptian banks at the higher end due to high policy rates. Cost-to-income ratios ranged from 45% at the most efficient operators to 60% at the laggards, with a median around 50 to 55%. Non-performing loan ratios averaged 3.1%, reflecting post-pandemic normalization and tighter IFRS 9 provisioning. The South African giants anchor the diversified banking segment. Standard Bank Group, with $172 billion in assets and operations in 20 African countries, is the continental leader by every measure. Its strategy combines a dominant South African franchise with selective expansion across sub-Saharan Africa, and a growing China-Africa corridor through its partnership with Industrial and Commercial Bank of China. FirstRand, despite a smaller footprint, generates the highest return on equity in the group, averaging above 20%, thanks to its disciplined product-focused strategy through FNB, RMB, Westbank, and Ashburton. ABSA Group, after separating from Barclays, has rebuilt a 12-country African footprint with strong corporate banking momentum. Nedbank focuses on Southern Africa with selective East African exposure and a unique alliance with Ecobank. The North African powers represent the second axis of diversified banking. Attijara Wafa Bank, controlled by the Al Mada Holding Company, is the largest bank in Morocco by market capitalization and operates a 14-country African network acquired largely through the former Société Générale Sub-Saharan subsidiaries. Its integrated model combines banking, insurance through Wafa Assurance, and consumer finance. Bank of Africa, formerly BMCE Bank, operates in 30 African countries through a federated model, with strong positions in Francophone West and Central Africa. The National Bank of Egypt, while not cross-border in the traditional sense, anchors the Egyptian market with $60 billion in assets and acts as a critical counterparty for the entire Egyptian financial system. Two strategic models dominate. The integrated universal model pursued by Standard Bank, First Rand and Adagera Wafa, owns insurance, asset management and wealth businesses outright, leveraging a shared customer base across business lines. Non-interest income contributes 40 to 50% of total revenue, technology investment is centralized, and returns compound through the cycle as cross-sell deepens. The federated multi-market model pursued by Bank of Africa and EcoBank gives strong local autonomy in each country, allowing navigation of heterogeneous regulatory regimes and consumer preferences. The trade-off is weaker cross-sell, duplicated technology platforms, and slower product innovation. Returns are more volatile and depend heavily on country-level economic cycles. 5 risks disproportionately affect diversified banks. Sovereign exposure concentration. Several diversified banks hold domestic government bonds equivalent to 20 to 40% of total assets, creating a sovereign bank nexus risk that regulators are now actively addressing. Cross-border repatriation. Capital and dividend repatriation from subsidiaries in currency-constrained markets like Nigeria and Egypt has become a material operational challenge. Regulatory complexity. Operating in 10 or more jurisdictions means managing 10 or more regulatory regimes, reporting calendars, and supervisory relationships. Technology legacy. Decades of acquisitions have left diversified banks with fragmented core banking systems, slowing product innovation, and reputational risk. As the most visible institutions, diversified banks face heightened scrutiny on environmental, social, and governance matters. The next decade for diversified banks will be defined by 3 frontiers. First, cross-border payments. The Pan-African payment and settlement system is dismantling correspondent banking friction, allowing diversified banks to monetize their cross-border networks more aggressively. Second, climate finance. Institutional demand for green bonds, sustainability-linked loans, and transition finance is growing rapidly, and diversified banks with origination scale are best positioned to capture this flow. Third, embedded banking. Integrating banking services into e-commerce, logistics, and gig economy platforms will create new distribution channels that bypass traditional branch networks. Diversified banks that execute on all 3 frontiers, while maintaining capital discipline, will extend their leadership over the coming decade. In summary, diversified banks will continue to consolidate African banking through the acquisition of subscale regional players. Cross-border payment interoperability will unlock a new wave of fee income for institutions with multi-market footprints. Climate finance origination will become a defining product set, with the largest banks capturing the majority of deal flow. And technology investment above 8% of revenue will separate leaders from laggards within 5 years. The diversified banking segment will remain the most influential force in African finance for the foreseeable future. Thank you for watching this examination of diversified banks.